So the last video came out with since the last video I came out with a naming convention. So I'm just doing chapter 2, part 1, video 1, and this one will be chapter 2, part 1, video 2. All right, so AddyClear is a great mnemonic. If you didn't watch the prior video, go back and watch it right now. It's a great mnemonic. It'll help you keep until you get it down pat, memorized, which account type is increased with a debit and which account type is increased with a credit. It's an awesome tool. Please learn it. All right, and we've covered this already in a prior video. I combined both of these. I thought it was easier just to combine them, and I did it right here. So I'm skipping that now. All right, so the accounting equation is assets equal liabilities plus equity. We've talked about that in almost every video we've done so far in this course. We can take that equity section and break it down into component parts, and I have done that here, and I think I'm going to rearrange it now to match Dyer. So dividends is Dyer, contributions, which is what we were calling in AddyClear, so I kept that consistent. So I is investments, revenue, expenses, and we'll get rid of dividends now. So D-I-R-E, Dyer. It works. I use these in college to get through when I needed to memorize things quickly. So AddyClear and Dyer, I think that'll help a lot if you choose to use it. So Dyer, again, what are the component parts of equity? Dyer, dividend, investment, revenue, expenses. They make equity increase or decrease. Dividends make it go down. Contributions make it go up. Revenue make equity go up. And expenses make equity go down. Example number 2. This is an example of a chapter 1 approach to looking at the accounting equation. And I just want to show you briefly, I am not going to use this on the test. I'm not assigning this as homework. Maybe if it was a 16-week course, I might have gone over it in a little more detail. I just can't. We're moving too quickly in an 8-week course. And so we have a contribution of $100,000 for common stock, $25,000 in equipment's been bought using common stock, and a loan of $10,000 in cash was taken out post a transaction. Well, paid in capital, common stock, same thing. PIC, paid in capital. So we had $100,000 in cash, $25,000 in equipment. So our equity went up because of I in Dyer, investment. We have $100,000 in cash, which you're saying, no, that's $110. We borrowed $10,000. So 100 plus 10 is 110. 25,000 equipment goes under the non-current asset, or we can just call it and then we owe $10,000. We'll just call it a current type debt because it needs to be paid in the next 12 months. Well, the point of this, I think I'm going to grab my pen. Now let me just do this. Point of this is assets total up to be what? 135, right? And I'll put a K there to represent 135,000. And then these two total up to be 135,000 also, right? The accounting equations, assets equal liabilities plus equity. We don't do it this way in accounting. It's just a great visual representation so you can see what's going on and it's in balance and how everything plays together. This is what we're after, journalizing. We will journalize We're fixing to talk about what that is in a second. And then there's another step after journalizing. All right. So let's look at the journal first. This is a journal back when it was manual bookkeeping before the advent of computers. It was in a book, and each page at the top of a journal, date, account title, an explanation, debit, and credit. Now, I'm not going to do explanations in this course. The book has examples. Look at them. I think that's important. I don't think we need to do them. And then the debit's on the left and credit's on the right. So, and this is just an example of a journal entry. And let me tell you what was going on here. On March 1st, we bought inventory and we financed it. It says accounts payable. And you don't need to know this. I'm just going to go over with you what a journal is, just to get an idea, and then we'll keep moving. We bought inventory for $10,000, and we financed the whole entire purchase for $10,000. So our debit equals our credit. We sold something, did something that generated revenue. They paid us $15,000 in cash, and recorded the $15,000 in revenue. And here we have we sold, cost of goods sold. And again, really not after talking about the journal entry, just to show you that the debit equals the credit. And just building on this, let's just look at it real fast. Revenue, talking about expenses. Remember the two types of accounts that go on the income statement, expenses and revenues, right? Revenue here is $15,000. Cost of goods sold is $5,500, which is like an expense. Selling expense, let's just say it was there. Administrative, $4,000. That adds up to be $10,000. So revenue minus total expenses, $10,000 equals $5,000. So, and then we would also have, besides the income statement, we could have the statement of retained earnings. What are the four parts again? Dividend, investment or contributions, revenue, and expenses. So when you look at this retained earnings statement, I don't see revenue and I don't see expenses on it, but they're there. Let me show you. Beginning retained earnings plus net income less dividends. So we have dividends on here, right? Right. So we have dividends, D and IRE. You don't always have investments. Sometimes the company will have investments, sometimes they won't. So we don't always have them, but we'll always have revenue and expenses. Maybe a company doesn't pay dividends. There's companies out there, like a lot of your tech companies don't pay dividends. So we have dividends here, but I don't see revenue and expenses, and I just said they're always there. Where are they? They're in net income. We've already subtracted revenue minus expenses and got the difference, the net amount of revenue and expenses that we call net income. So that $5,000 is here. So when we have net income, we have R&E. No investment, but we have dividends, revenue, and expenses. Income is revenue and expenses. And then balance sheet, we talked about it, assets equal liabilities plus owner's equity. And again, 6,100 equals 6,100. All right, so part 2, we're going to start digging deep in chapter 2. Part 2, lecture notes, we're going to start digging a little deeper into the chapter. So hopefully you're okay. Continue practicing on what account goes on what form. What account is an expense, revenue, liability, equity, asset. Start becoming familiar more and more with your income statement, your balance sheet, and your statement of equity. Those are the 3 that we need to know. So again, let me just show you. Income statement is first, then our equity statement, this one right here, and lastly and finally is the balance sheet. So this concludes chapter 2, lecture note 1, video 2. And if you have any questions, always email me, okay?